Hi guys, in today's video I'm going to be talking all about index funds, why I choose to invest in them and some of the pros and cons of owning them. Thanks for visiting my channel Free Your Finance. I'm documenting my journey towards financial independence. I talk about investing, property and savings, so if this is something you may be interested in watching, please hit the subscribe button below. So index funds are now my second largest holding in my portfolio after my rental properties. I think they're a fantastic investment and hopefully this video is going to help explain why I believe this. Now stick with me, later in this video I'm going to show you how £10,000 could have been turned into over £175,000 using index funds. So just a quick side note, I'm not a financial advisor, I just simply document my financial journey and the choices that I've made personally. I'm not asking you to copy me, you should do whatever feels right for you. If you need financial advice, please hire a professional financial advisor. So first of all, I need to explain what a market index is. There are many market indexes all over the world. For example, we have the FTSE 100 here in the UK, which tracks the 100 largest companies in the UK. And then you have the S&P 500, which tracks the 505 largest companies in the US. These market indexes display the performance of the market that they track. Not all market indexes only track stocks. For example, you can also get indexes that track materials such as gold and oil, and you can even get an index that tracks the inflation rate. The markets I invest in are stocks, so they're the ones we're going to be talking about in today's video. So let's dive in a little deeper and take a look at the S&P 500. This is one of the markets that I invest in personally in my portfolio. So as I've already said, the S&P 500 is actually made up of 505 of the largest companies in the US. These are companies such as Facebook, Google, Amazon and Apple, along with many more. Well, 501 to be precise. This index is market cap weighted. This means not all 505 companies make up the index equally. The larger companies ranked by market cap make up the larger proportion of the index. So, for example, right now, Microsoft makes up 5.665404% of the index, and Apple makes up 5.597454% of the index. The top 10 companies ranked by market cap size actually make up over 25% of the total index. This means it's going to affect the performance of the market index a lot more when Apple or Microsoft have a bad day compared to a much smaller company such as Gap, who make up just 0.008765% of the market. Referencing one of my favourite books, The Simple Path to Wealth, written by J.L. Collins, the market is self-cleansing. So if one company performs badly and drops out of the index, it's simply replaced by another. The worst one company can do is lose 100% of its value. However, the best one company can do is endless. It can grow 100, 200, 300% or more. I have a link to the book in this video's description. It is probably my favourite ever personal finance read. I'd highly recommend it. So hopefully this has explained a little bit more what a market index is. Many investors use the market index as a benchmark for them to outperform. They can do this by either picking their own stocks, which as you can imagine can be really risky, especially if you don't know what you're doing. Alternatively, they can hire an active manager to manage their portfolio for them. The problem with this is active managers charge high fees to manage your portfolios, and you're also relying on them making the right decisions. A study actually showed long-term over 90% of active managers fail to beat the market. Then in 1975, along come Mr. Jack Bogle, the founder of Vanguard. He created the very first index fund. His idea was rather than trying to beat the market, why don't we just try and match the market instead? He did this by creating funds that replicate the market index with similar holdings of similar weights. On the screen I'm showing Vanguard's version of their S&P 500 index fund known as VUSA. It's made up of 508 stocks compared to the 505 within the S&P 500 market index. As you can see at the bottom of the page, the holdings in market cap weight are very similar to the actual index. It performs very closely to how the index performs, which is great news, as if we look at the history of the stock market, it trends upwards in the long run. So fast forward 45 years and now there are trillions of dollars invested in index funds all around the world. So I can imagine you're asking, doesn't the stock market go down? Won't I lose money? You are totally right, the stock market will go down. Multiple times actually in your investing lifetime. This is something you're going to have to get comfortable with and learn to accept it if you wish to invest in the stock market. Looking at the S&P 500 performance over the last year, it looks like an extreme roller coaster at your favourite theme park. It has various ups and downs, some bigger than others, but it's hard to see any real growth. However, if we extend that time horizon to 10 years, suddenly it's much easier to spot the upward trend. Index investing is definitely long term. The stock market is definitely a volatile place, but hopefully the next couple of examples are going to help me explain why I believe it's a safe place for me to leave my money. So the two examples I'm going to show you are going to be if I invested from the month I was born back in 1990. This gives us a 30-year time horizon. Yes, 30 years is a long time, but no longer than if we were investing in our workplace pension. Now also, please bear in mind that there's a good chance that this is actually in index funds. However, you're paying a much higher fee to pay a pension company to do this for you. We're not going to speak about pensions in today's video, and I do accept there are some really good tax benefits for using pensions. So I'm now using a website called officialdata.org. We are going to imagine that we could put in £10,000 in 1990 and look at the performance of that over the following 30 years to today. Yes, I know this website shows the dollar sign, just ignore this as the actual numbers and calculation remain the same regardless to what currency the symbol is shown. So if we'd invested £10,000 in 1990, we would now have almost £176,000 in our portfolio. Let me make clear, this performance doesn't take into consideration inflation, although you can see the inflation adjusted calculation. Obviously 10,000 then was worth a lot more than it is now. Also, it doesn't take into consideration the fees you'll be charged for holding these index funds. This is why we always say how important it is to keep your fees as low as possible. The S&P 500 index fund that I am in with Vanguard charges only 0.07% as a fee. The growth has come from two different things. Number one, the value of the stock market has gone up, so therefore the value of our index fund has also increased. And number two, this graph is presuming that we're reinvesting our dividends too. Now let me quickly explain about dividends. Most index funds will pay a dividend yield to their investors. Companies pay a small dividend as a thank you to their investors at various points of the year. The S&P 500 index fund that I'm in pays its dividends quarterly, and I choose to reinvest those dividends back into the index fund. Yes, this does mean I have to log into my account every quarter, but this is as simple as logging into your bank account or onto your Facebook page. You can make the reinvestments with just a few clicks. It literally takes a couple of minutes. You can also get funds known as accumulation funds that will automatically reinvest the dividends for you. Finally, some people draw their dividends as a wage when they're paid it. This, however, will reduce your performance, and the growth in the graph that I showed you wouldn't be as high. Reinvesting a dividend introduces something known as compound growth. The idea that your earned money then earns money, and then your earned money earns money. I'm sure you get the point. Now, one day when I've retired, I will eventually draw my dividend as a wage. It's part of my retirement plan that along with the income I make from my rental properties, the dividend will be another stream of income during my retirement. However, right now, while I'm in wealth accumulation phase of my life, every penny I earn as a dividend is simply reinvested into index funds to hopefully grow more. Now, if we return to that graph, one other thing I wanted to show you is further down this page. This website gives us month by month performance of that £10,000. You will see that in the first month, our £10,000 actually loses money. So within a month, you've lost money. It then starts increasing in value. However, again by July, we have lost money. The reason I'm showing you this is to remake my point. The stock market is like a roller coaster. It goes up and down. It's a very scary place if you don't know this. Many make their investment choices led by emotion, so they sell when prices are dropping and they buy when prices are going up. This is actually the exact opposite to what would be the ideal thing to do. Let's keep scrolling down these rows and you'll see from July 1990 onwards our 10,000 is never worth less than our original investment. So over the following years, the value of our investment keeps going up and down, but increases more than it decreases. And then in 2008, we have a big problem. As you may remember, we had a big recession in 2008, mostly caused by banks overlending on mortgages. On April 2008, our £10,000 is now worth over £60,000. By February 2009, it's almost halved in value, down to just £33,000. Many people at this point would probably sell while they slowly see their investments reducing by thousands of pounds at a time. However, if we'd stayed strong and played the long game, by May 2020 our portfolio value would now be worth £175,816. Hopefully this example has helped show the value of long-term buy and hold investing. However, I can imagine some of you are saying, but Gary, we haven't got £10,000 to invest, what about us? I completely understand, not everyone's got £10,000, it's a lot of money. Instead, I'm going to show you a second option. So I'm now on another website, DQYDJ. Don't worry, I'm going to put a link to these websites in the description below. So now, instead of starting with the balance, we're going to invest £100 per month for the same 30-year period. These regular investments can easily be set up to be automatically made monthly, just the same as a bill would be paid each month. So we've chosen the same period, January 1990 to May 2020, and we're going to hit calculate. From investing £100 each month for 30 years, we've actually invested £36,400 of our own money. Yet our portfolio balance has grown to over £167,000. Again, minus fees and the consideration of inflation. Now, both of these graphs actually show us that the average growth during that time was between 8 to 9% annually. Now, bear in mind, we went through two quite big recessions in that time, with the 2000 dot-com bubble and the 2008 recession caused by the property crash. You've also got to think just how many other things were happening during that 30-year lifespan that could have had a negative influence on the stock market. However, still, throughout all of that, the stock market has averaged almost 9% yearly. Now, why don't you have a play with these two calculators, with the amounts you can afford and over a time horizon that suits you? Some may even be able to make an upfront investment along with monthly investments too. See what you get. I think you'll be really surprised. Don't forget, however, past performance isn't a guarantee of future performance, so please do be wary of this. So I'm going to quickly summarise what we've spoken about in this short video. I'm going to put it into pros and cons of index investing. So let's start with the pros. They're low cost. As I mentioned, they're created by a computer. You don't have to pay an active manager to manage your portfolio, to move the stocks about. Keeping your costs low maximises your profit. They're diversified. So rather than just owning one stock, which could potentially go to zero, you own hundreds, if not thousands of stocks instead. I know we've been speaking about the S&P 500, which is made up of 505 stocks, but there are actually global funds that can own thousands of stocks at a time. Finally, they pay a dividend. As I spoke about earlier in this video, you can choose to either draw this as a wage or reinvest it and hopefully get more growth in your portfolio. And then some of the cons. Lots of people don't have this long-term horizon. Maybe you want investments that are going to make you money a lot quicker. In my opinion, an index fund is probably then not going to be the right choice for you. They limit your gains. So again, as I mentioned, if you buy that individual stock that could be the next Amazon or Apple, obviously your gains could be much, much larger than being in an investment fund. Personally, having this diverse portfolio in an index fund outweighs it for me. Yes, it's going to give me average returns, but in the long run, I believe that it's a safe place to keep my money and keep earning those average returns of almost 9% each year. And then lastly, you can lose money. So all we've looked at is the history of the stock market and what's happened in the past. This doesn't mean this is going to continue happening in the future. All I would say to that is you can look at charts back to 130 years ago and the trend is still upwards. Companies are geniuses. They learn ways of making more money no matter what's going on. Right now we're going through this awful pandemic and there are still companies that are growing in size, believe it or not. So I hope today's video has helped explain to you a little bit more what an index fund is, why I use them, and maybe it would have given you a bit of an insight if it's something you might want to look at yourselves. I talk about investing, property and savings, so if you'd like to see more of my videos, please hit the subscribe button. My face should now be popping up on this left side. You can click that and click subscribe. Chat to you soon.